It's a Tuesday morning. A well-known tech stock starts to climb. There's no news, no analyst upgrade, no big announcement, yet the price keeps ticking higher, gaining momentum. It feels like a huge invisible buyer is in the market, relentlessly pushing the stock up. The chatter begins. Who is it? A sovereign wealth fund? A corporate buyback? The answer might be far stranger. The buyer might not be a single entity with an opinion at all. It might be the market's own machinery, a ghost in the system, forced into action by thousands of tiny bets placed just minutes before. 1,000 little strings, all pulling on one very large lever. This is the story of how the side bets can become the main event, and how modern markets have a powerful feedback loop hiding in plain sight. We are taught a simple story about prices. When a stock goes up, it's because there were more buyers than sellers. It's a nice, intuitive idea. It's also almost completely useless for explaining how markets actually work. It doesn't explain the speed, the violence, or the suddenness of some moves. The real story is often less about human opinion and more about mechanical obligation. In today's market, there are players who are forced to buy when prices rise and forced to sell when prices fall, whether they want to or not. They aren't betting on direction. They are reacting to risk. And the engine driving their actions is the enormous and booming world of stock options. To understand this, you have to meet the options market maker. Their job is simple in theory. They are always there, willing to quote you a price to buy or sell an option. When a retail trader or a hedge fund wants to buy a call option, a bet that a stock will go up, the market maker often takes the other side. They sell that call. By doing this, they've collected a small payment, the premium. But they've also just accepted a huge risk. If the stock skyrockets, the call option they sold could be worth a fortune, and they are on the hook to pay up. This is not a business of speculation. It's a business of volume and risk management. Their goal is not to bet against their customers, but to make a tiny spread on millions of trades while remaining perfectly neutral. To do that, they need to get rid of their risk the moment they take it on. How do they neutralize the risk? They hedge, and the primary tool is called delta. Think of delta as a number between 0 and 1 that tells you how much the option's price will move for every $1 move in the stock. It's like the option's shadow ownership of the stock. A call option with a delta of 0.30 or 30% will behave like owning 30 shares for every 100 shares the contract controls. So if a market maker sells one of these calls, they are now effectively short 30 shares. To get back to neutral, to flatten their risk, they must immediately go into the market and buy exactly 30 shares of the actual stock. Their position is now balanced. If the stock goes up $1, they lose money on the call they sold, but they make an equal amount on the shares they bought. They are hedged. Now for the crucial part. Delta isn't static. It changes as the stock price moves, and the rate at which delta changes is called gamma. Gamma is the accelerator. It's what turns a simple hedge into a powerful feedback loop. Think of it this way. If delta is your car's speed, gamma is how sensitive the gas pedal is. A high gamma option is like a race car. The tiniest touch on the pedal sends it lunging forward. A low gamma option is like a heavy truck. You have to push the pedal way down to get a response. And where is gamma highest? In options that are close to the current stock price and very close to expiring. These short-dated at-the-money options are pure hair triggers. Their delta can swing wildly with even a small move in the stock, and this creates a major problem for our market maker. Let's walk through the loop slowly. Imagine a popular stock is trading at $100. A wave of speculative buying comes in for the $105 call options that expire this Friday. Let's say 10,000 of these call contracts are bought from dealers. One contract controls 100 shares, so that's 1,000,000 shares of exposure. Initially, the delta on these calls might be, say, 0.25. To hedge, dealers go out and buy 250,000 shares of the stock. The market is balanced, but now that initial buying, plus some regular market activity, pushes the stock up to $102. Because of gamma, the delta of those calls is no longer 0.25. It jumps to, say, 0.40. Now, the dealer's hedge is wrong. To cover their 1,000,000 shares of exposure, They now need to own 400,000 shares. They already own 250,000. So what do? They are forced to go buy another 150,000 shares right now. This new buying pressure pushes the stock up again to $104. Gamma strikes again. The delta jumps to 0.60. Now dealers need 600,000 shares. They have to buy 200,000 more. Do you see it? Their hedging activity is now adding fuel to the fire. They are buying more stock simply because the stock is already going up. It's a purely mechanical, self-reinforcing rally. Now that we have the blueprint, let's look at this machine in the wild. Cast your mind back to the summer of 2020. Tech stocks were already flying high after the initial pandemic shock. Then, in August, they went vertical. The Nasdaq 100 index surged in a way that defied fundamentals. The financial press began hunting for a single massive buyer they nicknamed the Nasdaq whale. Who was causing this? The answer, when it emerged, was both shocking and revealing. It was the Japanese conglomerate SoftBank. But they weren't just buying billions of dollars of stock. They were buying billions of dollars worth of call options on stocks like Apple, Tesla, and Amazon. Reports suggested they spent around $4 billion on premiums, which translated into over $50 billion of notional stock exposure. Think of the dealers on the other side of that. They sold those calls and were suddenly massively short Gamma. They had no choice but to rush into the market and buy tens of billions of dollars worth of the underlying tech stocks and Nasdaq futures to hedge. The Nasdaq whale wasn't just riding the wave, its options activity was forcing the market's own plumbing to help create it. If the Nasdaq whale was a story of institutional size, GameStop in January of 2021 was a story of distributed force. The world focused on the short squeeze, the idea that hedge funds who bet against the stock were being forced to buy it back at higher prices. That was absolutely happening. But it was poured rocket fuel on by a parallel, equally powerful gamma squeeze. A huge army of retail traders, organized on forums like Reddit's Wall Street Bets, discovered a cheap and powerful weapon: weekly, out-of-the-money call options. For a few dollars, they could buy a call giving them the right to buy GameStop at a price that seemed impossible, like $400 when the stock was at $60. Dealers sold them these apparent lottery tickets by the tens of thousands. But as the short squeeze began to work and the stock started ripping higher, those impossible strikes started getting closer. The gamma on those cheap calls exploded. A move from $60 to $80 might cause the delta to jump from 0.05 to 0.20. Suddenly, dealers who sold these calls had to frantically buy shares to hedge a risk that didn't seem real an hour ago. They were forced to become the biggest buyers of GameStop, chasing the price up into the stratosphere, amplifying every leg of the rally. The SoftBank and GameStop episodes largely involved options that expired in a week or a month. The market has since created an even more potent tool for concentrating this effect: 0 days to expiration options, or 0 DTEs. These are options, primarily on big indices like the S&P 500, that are born in the morning and die in the afternoon. Their popularity has exploded. By late 2023, they often accounted for over 40% of the entire S&P 500 options volume. Because they have almost no time value left, their gamma is extraordinarily high right around the current market price. This compresses the entire feedback loop we described into a matter of hours or even minutes. A burst of 0 DTE call buying after a good economic data print can force dealers to buy S&P futures, creating a sudden lurch higher in the market that seems to come from nowhere. This is the mechanism on hyperspeed, creating intense, churning price action, especially in the final hour of trading as these options approach their final moments. This force works in both directions. First, what happens when the ride is over? When those calls expire worthless, the dealer's obligation vanishes. The shares they bought as a hedge are no longer needed, so they sell them. This can pull the bids out from under the market, creating a sudden air pocket where the price drops rapidly. The same ladder they were forced to climb up, they now dismantle on the way down. Second, the entire mechanism works in reverse. A wave of panic buying of put options, bets on a decline, can create a downside spiral. Dealers who sell those puts are forced to sell the stock short to hedge. As the stock falls, The put's delta increases, forcing them to sell even more, accelerating the crash. Finally, this effect can sometimes trap a stock. If dealers have sold a huge number of both calls and puts at a big round number strike, say $500, their hedging can act like a magnet. As the stock rises toward 500, they sell to hedge their calls. As it falls toward 500, they buy to hedge their puts. The result? The stock gets pinned to that strike price into expiration, unable to break free. This isn't about predicting the market. It's about understanding the pressures inside it. The pattern is often the same. You see a huge buildup of volume in short-dated call options, clustered around strikes just above the current price. You see it around big events like earnings reports or key inflation data. The conditions are set for the accelerator to be pushed. When the buying comes in, the rally can feed on itself, running further than fundamentals would suggest. Then just as quickly, the options expire, the positioning flips, and the support vanishes. This reveals a fundamental truth. Markets don't just move on opinions. They move on obligations. And the dealer's obligation to manage their risk is one of the most powerful, non-negotiable forces in the entire financial system. So what does this all mean? It means the stock market is no longer just a place where you buy and sell shares of a company. The derivatives market, once a sideshow, has grown so large that its plumbing can now steer the main event. It introduces a volatility that is not always tied to new information about the economy or a company's profits. Instead, it's driven by positioning and the mechanical demands of hedging. The next time you see a stock inexplicably melting up or a sudden, violent reversal at the end of the day, don't just ask who is buying. Ask, who is being forced to buy? The answer reveals a market that is less a simple weighing machine of opinions and more a complex reflexive engine where the act of betting on the price can, itself, change the price. Understanding the machine doesn't make the future certain, but it does make the present a lot less mysterious. Thanks for watching Tickerlore. If you appreciate these deep dives into the mechanics of how markets really work, hit that subscribe button. We skip the hype and the buy-or-sell noise to focus on the timeless patterns of bubbles, crashes, and the structural forces that move prices. There's always more to learn about the plumbing. See you in the next one.